Hello, this is Gary Dugan from the Global CIO office, and I'm just going to quickly walk through what happened in the markets last week and some reflections on President Trump's tariffs and some of the economic data we're due to receive. When we look at the markets, and I'm going to use Bloomberg here just to give a quick snapshot of the performance of markets through last week. And I'm starting here with the equity markets. You can see in generally on the right-hand side of the page there, the 5-day percentage change is showing you that over the week, most equity markets were higher. The global equities up around about 0.3%, according to Bloomberg. But a difference, of course, between what was happening in the United States and elsewhere. In the United States, things have just got a little bit more challenging, obviously with the tariffs. But really, the valuation is still a challenge for the markets in general, even if the backdrop is more positive. The large gains we were seeing are still coming from the places that we saw at the end of last year. That's the Kospi up 5.6% over the last week, and the Nikkei up 5.5%. This basically reflecting lower valuations, and any spark of good news is getting greater returns. Now, returning to the US, it's not certainly not been bad news. Indeed, last week we were quite surprised to see the strength of some of the macroeconomic data. And if I go over to some of the data we've seen most recently, it included the Philly Fed survey, which was a lot stronger than expected. Indeed, the market had been anticipating that this survey would still be negative because much of the manufacturing data through the fourth quarter of last year was bad. But it's seen almost a remarkable turnaround. And this was playing out also in the Empire survey that we saw again last week. So both of those surveys pointing to a revival of the manufacturing sector, which probably plays out to some good statements as we go through the corporate results season, and still some solid returns from the US equity market. Elsewhere, the bond markets were a little bit more mixed, and this is probably my key concern when we think about markets through the first half of this year is what if the 10-year yield breaks towards, let's just say, 4.5%? Well, last week we saw it really pick up to above the 420 level. And I have to say now with President Trump threatening tariffs, which could potentially put 20 or 30 basis points on the headline rates of inflation, this is going to be the headwind to the bond market. The 10-year yield rising still further and potentially compromising the level of P multiples in the US equity market. Now, if I look at the very broad bond markets on this next screen, you'll see that the returns over the last month have been relatively modest. We've seen gains of around about 0.14 on the global aggregate, but the better gains are still coming from the high yield areas. So if you look towards the bottom of this screen, let me just push these numbers a bit higher, you can see that the yield or the spread, should I say, the spread over treasuries in the case of global high yield is 277. And that is the lowest level that we've seen in the last month, and I think 6 months. Corporate high yield in the US, 251, Pan Europe, 267. So there's still a lot of demand for global high yield, almost by any market. And you are getting some of the lowest spreads that we've seen in some time. So most of the challenges for the bond market are coming in government bonds and particularly US treasuries. And in fact, if I just look at that last week, that spike that we saw in 10-year yields left most of the returns as being negative in the United States in terms of US aggregate, the credit market, and US treasuries. So this is the headwind, I think, to markets moving forward. Now, off to something which is still everyone's insurance policy on what may go wrong this year, and that's the precious metals sector. Precious metals had another good week, although there was some profit taking towards the end of the week. So on the chart you see in front of you, you've got both the silver market and the gold market, silver in white and gold in yellow. We have struck higher. We're a lot higher than we were just a few months ago. And I really can't see where any selling pressure should come from. We know there are very significant shortages of both gold and silver in the retail market around the world. And investors are increasingly paying up for higher allocations. So you're seeing premiums of up to 10% on physical gold and silver. So I'm going to go back to some of the good news, and the good news was coming in particular out of Japan. If I can get my fingers across the keyboard here a bit better. The Topics Index, which is the main benchmark for the Japanese market, has been performing well. It's almost gone up exponentially in recent months, as you can see with the data points just through January, where we've gone up almost 200 points. So the good news is, and the new news is that the Prime Minister in Japan, the lady who came into power quite recently, is likely to look for a fresh mandate by calling early elections, hoping that the LDP will get an absolute majority in the Diet, allowing them to push on with the kind of changes in policies which they believe are helpful to the economy and would almost certainly be very good news for the equity market. So this market has done spectacularly well, but we're still sticking with it. And I think one of the gains that you're going to see very soon is probably a topping out of the weakness of the Japanese yen and seeing the yen appreciate modestly as we go forward. And that in part will be reinforced by looser fiscal policy leading to tighter monetary policy. So interest rates to rise and support the yen. So possibly coming back from the kind of 158 levels that we closed that against the dollar last week, back towards the 145. That would be pretty handsome effective appreciation of the currency to enlarge the absolute returns for international investors. So let me just close by looking at some of the data we're expecting this week and what impact it will have. Surveys that we're having and data is not really the biggest numbers that we typically get during the month. I just point to the PCE numbers. This is the measure of inflation that the Federal Reserve favors. And that is still in November at 2.8%. So again, all this pressure on Powell, the whole dialogue around a new chairman. At this point in time, inflation is not towards the 2% level that the Fed would feel comfortable with. And therefore, I don't believe there's really a big scope for a cut in interest rates at either of the next two meetings. But to finish, all the focus for the next couple of days will be on these tariffs. The tariffs will bring down European growth by as much as 70 basis points, which would not be good news for the European economy. And secondly, could push US inflation up by 2 to 3 tenths. So my goodness me, we'll be back towards the 3% level again on the core PCE deflator. So that would mean that whoever comes in to lead the Fed will come in with a bit of a problem. So I'm not sure that Donald Trump will continue to push through these tariffs. One hopes that he kind of sees sense. But some of the challenges, again, remain very geopolitical. If it was not for that geopolitical, well, the ham-fisted move at the weekend, I would have been reporting stronger than economic data in the US and upside for US equity markets. But now, with this challenge, things are going to play out a bit more difficult. Anyway, leaving it there. Thank you very much.